FA1 Part A. Introduction to Transaction Accounting. Chapter 2. Assets, Liabilities and the Accounting Equation. The topics that this presentation will cover are Accounting Fundamentals, Assets and Liabilities, the Accounting Equation, Accounts Payable and Accounts Receivable, Double Entry Bookkeeping, Capital Expenditure and Revenue Expenditure. 1. Accounting Fundamentals. It is vital that you have a thorough understanding of the principles of double entry bookkeeping. These principles apply to both credit and cash transactions. The double entry principle states that every transaction has two entries, a debit entry and a credit entry. 2. Assets and Liabilities. A business owns assets, and owes liabilities. An asset is something valuable that a business owns or makes use of. A liability is something that owed to somebody else. Both assets and liabilities can be current or non-current. Current means that the asset is used or liability needs to be paid within 1 year. Non-current means that the asset will be used or the liability is kept for longer than 1 year. 3. The Accounting Equation. Assets equal capital, equity, plus liabilities. Capital is an investment of money, funds, from the owner or owners, with the intention of earning a return, profit. The business owes its capital and profit to the owner or owners. Retained profits. Assets equal capital introduced, plus retained earnings, plus liabilities. As long as the business retains the profits and does not pay out the profits to the owner or owners, the retained profits are treated as addition to the owner or owner's capital. Increase in net assets. Net assets equal total assets plus total liabilities. At any point in time, net assets will equal capital introduced plus retained profit. At a later point in time, increase in net assets represent the additional profit made. Total net assets at that later point equal capital introduced plus increased retained profit. Drawings. Drawings are amounts of money taken out of the business by its owner or owners. Assets equal capital introduced plus earned profit less drawings, plus liabilities. 4. Accounts Payable and Accounts Receivable. Accounts payable is when the business owes monies to suppliers, creditors. The business has purchased goods from a supplier and now owes money to him. An account payable is a liability. Accounts receivable is an amount of monies owed to the business by customers, debtors. The business has sold goods to a customer and now the customer owes the business money. An account receivable is an asset to the business. 5. Double entry bookkeeping. The double entry principle states that every transaction has two accounting entries, a debit entry and a credit entry. The total value of debit entries will equal the total value of credit entries. Debit entries. An increase in assets. A decrease in capital. A decrease in income. An increase in expenses. Credit entries. A decrease in assets. An increase in capital. An increase in income. A decrease in expenses. Ledger accounts. Transactions are recorded in ledger accounts. Ledger accounts are also known as T accounts because of how they are normally drawn up on a page. Each ledger account has a debit side on the left and a credit side on the right. Cash transaction. In a cash transaction, when we sell goods, our cash account, an asset, increases so it is a debit entry. The other entry, the credit entry, will be sales. When we buy goods, our cash account, an asset, decreases so it is a credit entry. The other entry, the debit entry, will be the corresponding expense. For examples of recording cash transactions, see page 38 to 40 of your interactive text study guide. Credit transactions. When we sell goods on credit, our sales, an income, increases so it is a credit entry. The debit entry is not cash because no cash has changed hands yet. Instead we use an account called accounts receivable or debtors, which is an asset. Once the payment is received, our cash account then increases, so it is the debit entry. The credit entry will be the accounts receivable, because the account is being paid, and the asset is decreasing. The net effect will be the same as a cash transaction, the only difference is the time delay in which the account receivable was used. Credit transactions. When we buy goods on credit, our expense increases, so it is a debit entry. The credit entry is not cash because no cash has changed hands yet, instead we use an account called accounts payable or creditors, which is a liability. Once we make the payment, our cash account then decreases, so it is the credit entry. The debit entry will be the accounts payable, because the account is being paid, and the liability is decreasing. The net effect will be the same as a cash transaction, the only difference is the time delay in which the account payable was used. 6. Capital expenditure and revenue expenditure. Capital expenditure. Capital expenditure is expenditure for obtaining non-current assets, or the improvement in their earning capacity. Capital expenditure is shown as an asset in the books of accounting. Revenue expenditure. Revenue expenditure is expenditure which is incurred for either the purpose of trade or the maintenance of non-current assets. Revenue expenditure is shown as part of the calculation of profit, as expenses. Treatment of capital and revenue expenditure. If capital and revenue expenditure are not identified correctly, the resulting profit figure will be wrong and misleading. If capital expenditure is treated as revenue expenditure, then it will be incorrectly added to expenses and the profit will be understated, too low. If revenue expenditure is treated as capital expenditure, then it will be missing from expenses and the profit will be overstated, too high. Quick quiz. Question 1. What is an asset? Question 2. What is a liability? Question 3. State the basic accounting equation. Question 4. What is capital? Question 5. What are drawings? Where do they fit in the accounting equation? Question 6. What is the main difference between a cash and a credit transaction? Question 7. What is an account payable? What is an account receivable? Question 8. Define double entry bookkeeping. Question 9. What is the double entry when goods are sold for cash? Question 10. What is the double entry when goods are purchased on credit? Question 11. Distinguish between capital expenditure and revenue expenditure.